Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Vivek Iyer. Hey Vivek, good afternoon. Well, we started with a bang. We've come up from those highs. We were closer to that 25,000 mark. Now we're at that 24,820 mark. Mid-caps, they're sulking in trade today. And we do have a lot of stocks or sectors which have come up from the highs.
That's right. Good afternoon. Clearly cooling off. In fact, even as we speak, the mid-cap index in the red. The advanced decline ratio now, especially in the broad end of the market, skewed towards the negative side. But we have a lot lined up on the show, so let's start off with the top headlines. Frontline stocks perk up after the big GST revamp, even as mid-cap see some profit taking after a few sessions of outperformance. Auto and FMCG are the big gainers, even as energy and utilities drag.
Stocks like Dome, Cello World and Flair writing surge after Centre Slash's GST rate cut from 12% to nil on educational services and materials, including books and learning aids. Management of Navneet Education tells CNBC-TV18 they will pass on the entire benefit to consumers.
Insurance stocks slip from highs as CBIC chairman tells CNBC-TV18 that there is no input tax credit while exempting GST on insurance.
Footwear stocks like Bata, Campus, Activewear and Metro Brand surge as Centre cuts GST on footwear below 2,500 rupees to 5% from current 12%. Footwear priced above 2,500 rupees will be taxed at 18% versus the current 12% mark.
Solar industry is under pressure after an explosion occurs at its factory situated in Nagpur. 1 killed, 8 injured in this accident.
Okay, all right. Those are the top headlines. Let's revisit markets yet again. 102 points higher on the Nifty right now. But there is pressure on the mid-caps. 140 points gone on that one. If we talk about the movers in the sectoral space, the CPSE index that was lower from the start of the trading session, and that has continued to be the case right now as well. What has come off from the highs has been the auto names, the consumption space. IT too is seeing some pressure from the top. So these are some names which are in the green, yes, but there is some pressure from the top, from the highs of the day as well. And mid-caps, we've been talking about that. The advanced decline ratio is in favor of declines as we speak, and a lot of moving parts in the broader markets as well. But some stocks which are doing really well. Electronics Mart, 14% higher on that one. Atul Auto, that one is up 12%. We have NetWeb that continues to see higher highs, 6.5% higher there. We do have Vishal Mega Mart, which is sitting with gains of around 3.5%. So a whole host of stocks which are on our radar, and let's take that forward. Mid-cap movers, that's the segment that we'll be talking about. Vivek has gone to the big wall. Tell us more about the mid-caps moving in trade, Vivek.
Well, that's right. A bit of a dampener given the fact that we actually expected quite a lot of fireworks, especially in the broader end of the markets, given the fact that so many rate reductions seen across most of the consumption names. But despite that, quite a few stocks making all the strong moves. The footwear GST is something that has come down significantly, and that clearly is seen aiding demand. Look at Bata, up after almost 6.5%. Campus as well as Metro Brands doing very well for themselves. The entire education sector, GST there is quite nil. So look at DOMS, Cello World, Flair writing, all of these stocks doing very well in the session today. Muthoot Finance is doing quite well. That particular stock has perked up to the day's high in the last half hour or so. Gillette, this particular stock from the broader end of the markets up almost 5%. Colgate as well as Imami from the broader end of the markets, especially when you're looking at toothpaste GST getting cut. Both of these names as well as the FMCG pack doing quite well. On the other hand, quite a few laggards as well. Have a look at Paytm, one of the top laggards, especially as far as the broader end of the NSE 500 is concerned. Solar Industries, we told you about the negative news flow. That stock down almost 2%. Ola Electric, after the one-way rally the stock has seen in the last month or so, today is seeing quite a bit of profit booking, down almost 6%. And Kalyan Jewellers, especially in this particular name, quite a bit of short build-up seen. That stock down 2% in the session today.
All right, some interesting names there. Thank you so much for that, Vivek. Let's do one thing. We'll slip in a short break. When we come back, we'll get you more on the markets and stock-specific action. Stay tuned for that. Welcome back. You're still tuned into Mid-Cap Radar. Well, Nifty steady where it was when we started the show as well, but some stocks like MIC Electronics, that's higher. That's up almost 18.5% right now. Atul Auto is the other one. Aditya Vision is a stock which is surging. It's up around 10%. And a lot of movers on the back of the GST rate cut announcements that have come by as well. So let's do one thing. We've spoken about how these GST rate cuts would impact specific companies, specific stocks. But what is the impact on GDP overall? How does it impact macros? Let's get in a conversation going. Sakshi Gupta, Vice President and Senior Economist, HDFC Bank. And we're also joined by Kanika Pasricha, who's the Chief Economic Advisor, Union Bank of India. Ladies, good afternoon. Thank you so much for joining in. Sakshi, let me start with you. It is largely in line what was expected. What are your GDP targets for FY26, FY27? Do you think the government has given an estimate of how much GDP will be impacted? What kind of changes are you seeing to your GDP targets? Which are the specific sectors which will see a lot of impact because of this?
No, thank you for having me on the show. Look, of course, the GST announcement that has come in is clearly going to be positive for consumer demand. Particularly, I think for the lower and middle segments of the income pyramid. Right? So if you look at, the benefit of the GST rate cuts, especially the move from 12% rate to 5% rate, which is coming in a lot of the food, beverages and essential items. I think this is something that benefits, the middle and the lower middle, income segments. And to that extent, we do see that this will have a positive impact of about, 15 to 20 basis points positive on our GDP growth estimate for the year. Our baseline currently was 6.3%. So because of this GST announcement, we do see a positive impact there. I think this is something that will play out, not just in the near term, but I think over the next 12 months. We could, in the second quarter, we could, see some postponement in demand and demand starting to pick up, end of September when these GST rates come into effect. But Q3, I do, of course, expect that there's going to be a pent-up demand effect and, that playing out on the consumption side. I think this comes at a time when for households over the last couple of quarters we have seen that because of high inflation and of course slow wage growth, we had started seeing consumption kind of slow down. So in that context, definitely this is a positive booster for demand.
Right. Kanika, let me also bring you into this particular conversation. Clearly we are seeing a shift in stance from the government as well as RBI. Earlier, it was all about capex and the kind of boost that we were seeing towards the industrial sector. This time around, we've seen three key moves, right? We've seen personal tax rates getting cut, we've seen RBI cutting rates, and now we're seeing the GST kicker. FY26, FY27, what kind of growth rates are you penciling in? And has both Centre as well as RBI exhausted all the arsenal as far as their own armory is concerned?
So I would say let's be optimistic. Let's not think that they've actually exhausted all their arsenal. There's still a lot more to go. In fact, there's been consistent discussion by the government and RBI to think of more policy proposals to support the economy. So first, compliments to the government. They have given us a GST rate cut and completely agree with Sakshi. It's a demand booster. Given the kind of items that have been lowered from 12 to 5% and 28 to 18%, though the high-end premium or luxury segments have been raised, the base rate has come up from 28 to 40% for a luxury car, though the net rate comes down still from 45% effective tax rate to 40.
Right.
For your premium travel also goes up from 12 to 18. Now, quickly on your question, policy space. See, we think that, yes, after income tax rate cut and the RBI rate cuts, plus the GST reform, just purely basing on GST, agree with Sakshi's number of 10 to 20 basis points. In fact, the number can only be higher if the ease of doing business segment and the tax compliance improvement segment actually gives us much more dividend the way it has been giving in case of income tax in the last few years. But last but not the least, purely the growth number for the year, which be up to 6.5% to align with MPC after the 7.8% booster shot for Q1, which was primarily front-loaded growth. Another factor which we can't ignore in growth is the US-India trade deal stalemate, which actually affects 1% of GDP, around $45 billion across sectors like shrimps, textiles, gems and jewelry, auto components, chemicals. That itself has to be taken into account as well, which is why after this number, we'll not be upping our forecast. It's a close wait and watch, 10 to 20 basis points. So this year, 6.5%. I would say with a downward bias, if the disruption remains for longer, salutary effect provided by the government, definitely. And RBI also may probably add with another 25, 50 basis points token rate cut. Next year, purely on base effects, some upping can happen, but broadly trend forecast, trend GDP's mapping in terms of its decadal trend of 6.5%, and may stay there. Thanks.
Got it. Thanks for that perspective, Kanika. Sakshi, let me come to you. We've spoken about the growth perspective, but now that we're putting in more money in the hands of consumers, what is the impact on inflation? What are your targets in terms of how it would impact that number?
Right. So look, on the inflation front, there are a couple of things, right? If you look at the new revised rates on GST, then de facto, that brings, a downside, impact on our overall inflation forecast for the year, which could be, anywhere between 60 to 80 basis points. However, I don't think that that's going to be, fully passed through. So assuming, that 50% of the benefit is actually passed on in a very graded manner to, consumers, I would at this stage see a downside to my annual inflation forecast of 2.8%. And the downside could be anywhere between 10 to 15 basis points. My forecast was already lower than what the RBI is expecting for FY26. The second thing, I think you were hinting more at the fact that, look, if there is going to be a pickup in consumption, does that end up being inflationary in nature down the line, right? So from that perspective, I think that, for now, at least the problem has been that consumption has been very low. Capacity utilization rates in the economy have also been, across sectors between 70 to 75%. So I don't think that we are anywhere near a situation where there is heating up in the economy that can happen, that can lead to a, upside inflationary impact. So at least for this year, I think this GST announcement is actually going to pull down the overall inflation number.
Sakshi, a quick follow-up question. Now, between the center and the states, almost 3 to 8% of budgeted GST revenues would be impacted, right? So in that context, how do you see that getting offset? What do they have in their arsenal to go ahead and equip themselves to offset these laws?
Right. I think, if you heard the press conference yesterday, the Revenue Secretary, did mention that the revenue impact of this GST announcement is close to, 48,000 crores. I think that is not an extremely high number at this stage. And I think they are relying on the fact that there will be some buoyancy on the tax front. My sense on the fiscal side at this point is that, look, the overall GST revenue number is really high. And we have some cushion from, things like a higher RBI dividend that we got this year. Also, the government seems to be making a little bit headway on the disinvestment front. So I would at this stage expect perhaps some amount of expenditure rationalization if required to balance the fiscal math, at least at the center level, and for them to kind of achieve their fiscal deficit target.
Got it. All right. Sakshi and Kanika, it was a pleasure speaking with the two of you and understanding what the impact on macros could be and the overall picture as well. But for now, we'll slip into a short break. When we come back, we'll get you more on the markets and stock-specific action on the other side. Stay tuned. Welcome back. You're still tuned into Mid-Cap Radar. Well, we've been getting a lot of opinion and reaction for that big GST rejig. In fact, Asif Malbari, who's the CFO of Godrej Consumer Products, says, and I quote, "We welcome the government's initiative of lowering taxes to boost consumption. This is a positive trigger for demand and strong driver of volume growth as well. This move will ultimately contribute to overall economic momentum. GCPL has leading soap brands such as Synthol and Godrej #1 and hence welcomes this move. We are fully committed to ensuring that the GST rate reduction benefits are passed on to consumers."
Well, moving on, we'll now go ahead and see what are the impact as far as individual sectors are concerned, as well as individual stocks are concerned. We have both Winnie as well as Ria joining in from the research team. Winnie joins us first. Winnie, what is the impact as far as the textile as well as the apparel space is concerned? What kind of rate rationalization have we seen here?
Hi Vivek, good afternoon. So, at least after that 50% tariff, which had impacted most of these textile and apparel players, at least this is some bit of a relief, right, that we're watching out for. Given the reduction in this GST rates that we'll see coming in could lead to a reduction in procurement prices for key input raw materials for most of these companies. Now, obviously, let's talk about where we're seeing the reduction coming in. Man-made fiber earlier was 18%. That's come down to 5%. Man-made yarn, that was earlier 12%. That's come down to 5%. Most of the raw material, which was in the 12 to 18% range, has now come down to 5%. So that uniform rate of 5% across key raw materials. Not only that, ready-made garments or finished products, that has also seen a reduction in terms of the rate as well. Now, for ready-made products or finished products like carpets, rugs, bath linen, as well as other products in towels, etc., also seeing a reduction to 5% from previous 12%. For apparels, there's a change in rate, right? They had said that first 1,000 rupees, they were being taxed at around 5%. Now that amount has been changed to 2,500 rupees. So up to 2,500 rupees value product, they will be taxed at 5%, and above that is going to go to 18%. So that is also a benefit that comes in for apparel players. And that is why we're seeing a boost coming in for most of these names, whether you talk about Arvind, Wellspun Living, Indocount, KPR Mills, Nitin Spinners, across the value chain benefit for textile players.
Okay, makes sense. And while the stocks are not buzzing on higher volumes or higher rates, but still it's a big change that we have seen in this particular space overall. Ria, there's some rationalization with Scamba and fertilizers and chemicals as well. Detail that for us.
Well, yes, there are two major changes when it comes to the GST rate cuts for fertilizers and agri-chem companies. The first one is the correction of the inverted duty structure in the fertilizer sector. The GST rate has been cut from 18% to 5% for sulfuric acid, nitric acid, as well as ammonia. Now, in terms of the impact of this will lead to a reduction in input costs and working capital, and also lead to better margins for fertilizer companies. And specifically for the correction in the inverted duty structure, the reason that this is important is that all three products of these products are key raw materials for these fertilizer companies, and now that this has come down from 18% to 5%, this will be a big positive for the company, because earlier these companies were paying a higher tax rate for their raw material inputs, and they were selling these finished fertilizers at a GST rate of 5%, which had also led to some accumulated unutilized input tax credit for these companies. So when these new rates come into effect, this will be a big significant positive for these companies. In terms of the key beneficiaries, we have Deepak Fertilizers, GNFC, Chambal Fertilizers, Coromandel, Rashtriya Chem, National Fertilizers, among other fertilizer companies. The second important move that has come in is for micronutrients and agri inputs. The GST rate out here has been cut from 12% to 5%, and in terms of the impact, this is going to lead to improved affordability as well as a demand uptick in this segment, and this will be positive for players like UPL, PI Industries, Rallis India, Bayer Crop Science, Dhanoka Agritech, as well as Best Agri Life. In terms of the stock prices today, we're seeing a bit of a mixed picture. Some of these names are seeing fair bit of profit booking, but overall this is a big positive for the industry.
Okay, all right. Thank you so much for that, Riya. By the way, let's take a look at the markets. When we started the show, it was up around 100 points. Now it's up to 75. So there is some selling that we are seeing from the top. We have stocks like Dr. Reddy's, Bajaj Finance, Eicher Motors, Bajaj Finserv, HDFC Life. Some of these insurance stocks, of course, which are going lower. HCL Tech is the other one, which is putting some pressure on the markets from the highs as we speak. But you know, the GST Council has exempted individual life and health insurance from GST. In addition, GST on reinsurance costs is also exempted, which is confirming a CNBC-TV18 news break. We spoke to Yashish Dahiya, the chairman and group CEO at PB Fintech, and the management of Neva Bupa to get their views on how this rejig could affect the business. Listen in.
So it is not like one is making too much money or anything of that sort of profit. Terms like profiteering, etc. do not. Which insurance company is making crazy profits? And which distributor is making crazy profits? Right? As a percentage of premium. If the benefit is 18% and the cost is 5% or 10%, a benefit is going to the consumer, is it not? Right? Whatever the industry can afford, it will take.
Well, that was the management of Policy Bazaar, and that was something that you actually saw quite a bit of negative news flow coming in, and you did see most of the stocks going ahead and reacting negatively. But remember, the GST Council has also exempted individual life and health insurance from GST. In addition, GST on reinsurance costs also is exempted, confirming a CNBC-TV18 news break. Earlier today, we spoke to the management of Neva Bupa, and this is what they have to say.
Do we get the input credit, because now it's into exempt mode? As of now, there is no big clarity, but assuming we will get some more clarity after this. But we have three costs. One is reinsurance cost, then is our operating cost, commission cost. Reinsurance is also exempted, so hence some of our costs will get there, which is waived. The rest two costs, which is the commissions cost or the other expenses, etc. cost, that is something which will not get the benefit out, and that's what we need to figure out. How do we manage this? Because we want to give the benefit to the customer. We want to give the most of the benefit to the customer.
All right, a further fall is what we are witnessing in the markets. Nifty is up just 60 points right now. Important to track that. The mid-caps are down 0.4%. So we'll keep doing that for you, the moves in the market and individual names as well. For now, we'll take your leave on this edition of Mid-Cap Radar. Special coverage on GST continues when we return.